It's JP Morgan Healthcare Week, which is one of the most exciting weeks for health tech and biotech innovation all year. It's pretty much the Super Bowl of healthcare innovation, where everyone from the industry all come to San Francisco for this week-long conference hosted by JP Morgan. The conference itself basically sets the tone for healthcare innovation for the year, so there's a lot of really exciting panel discussions and a lot of different topics discussed from industry leaders that help guide how we can make the healthcare system better for everyone. The conference itself is thousands of dollars and invite only, so I will not be attending. However, the entire city turns into this really exciting mix of networking events, social events, meetups, panels, pitch nights, you name it. There's so many events. Because my grad school program at Stanford is at the intersection of healthcare innovation and technology, and I'm also interning as a fellow for a techbio focused venture capital firm in the Bay Area, I have the chance to go to some really exciting events, and I've even been able to plan a few events of my own. So I'm excited to bring you along with me for my first real week at JPM.
I started the week by hosting a Run Club event with two other fellows from my VC and a friend who hosts a local biotech run club. Our path was right on the water, and the event was open to anyone in tech bio to kick off the week in an informal, friendly way. And we had nearly 60 people show up from all over the world. Tech bio is a sector that sits at the intersection of technology and biology, where companies use things like AI, machine learning, and computational biology to accelerate and improve biological research, drug discovery, and healthcare delivery. We started by stretching, and we also shared a bit about what areas our VC typically invests in, and then we ran or walked a 2.5-mile loop while chatting with a lot of incredible scientists and founders. They're working on things like creating drug discovery platforms to predict and personalize treatments for Alzheimer's or cervical cancer, or discovering ways to continuously monitor hormones so women can have a clearer understanding of our cycles. I chatted with a few more founders over coffee, and before I knew it, it was time to head to a VC mixer at a very cool VC office that also doubled as a birthday party for one of the partners at the firm.
I just got done going on a walk looking like this, all for my hair to probably be flat in like 20 minutes, but it's fine. Just got done, so now I'm gonna take my hair out and drive all the way to SF. Let's see how it turned out. Today I have two events. The first one is actually at diptyque, which I'm so excited about. It's a life science networking event. I love when you can tell an event was just planned by a woman. Okay, hair-wise, I think this is good. Let me put on my outfit. We are going with an easy outfit. I just got this nice silk skirt from Zara, and I'm gonna pair it with these Dolce Vita boots. This is the look. I'm gonna head out now. I am looking at about an hour and a half of traffic up to the city, so I need to go soon.
had such a lovely time at the diptyque event and so glad I went. I did come home with a little goodie that every attendee got, which is just so crazy. Either a full-size candle or a full-size perfume. It feels like you have just picked a bowl of fresh figs. I'm very excited. I think this could also be a really fun one to layer. I'm definitely a big fan of gourmand scents, things that are more warm and vanilla. And I think a vanilla and fig sort of layering might be really fun. So now that I have you here, I also wanted to spend some time talking about what venture capital really is and also sharing some advice for those of you who might be interested in entering the VC world or interested in starting your own startup company. I feel like there has always been this big black box around VC, like nobody really knows what it is, and those who are in it don't really want to talk about what it is. So it just sort of stays a mystery. I think because it is such a lucrative space, and the more competition there is in the VC space, the harder it is to invest in the best startups. I would love to share what I've learned with you because it is not this big, scary, complex thing. I think things get more and more complex as companies mature, and those are sort of different styles of venture capital. But today I'm going to be focusing mostly on early stage. The concept of venture capital is basically rooted in venture funds. Funds are investment vehicles that basically pools a bunch of money from different people that they call LPs or limited partners. These funds are in the hundreds of millions typically. And LPs are typically people who are part of endowments, they're wealthy people, celebrities, all kinds of different sources can be LPs. And they are basically recruited to invest their money into these funds. General partners, GPs, will take your money and ideally invest them in high growth, high potential startups. And these startups will give you equity for your money. Equity is basically a percentage of the company, and we could get into a whole lot of details about what type of equity. There's a whole bunch of different concepts there, but let's just say a portion of the company. And funds are typically a 10-year term. And after that 10 years, you are hoping that your money not only gets returned, but you get a major return on investment. Ideally, you've doubled, tripled your money, or maybe more. So, how do venture capital firms themselves make money? They typically do this on what they call a 2 and 20 structure. What this means is they take a 2% management fee from the fund. And so you can imagine when you're managing a fund that is hundreds of millions of dollars, 2% certainly adds up and is quite a bit of money. They also take what they call carry, and this is the 20. So what this means is they take 20% of profits from an investment after it's been returned. So after they've returned the initial capital to their LPs, they get to take 20% of the profit for themselves. In this 220 structure, GPs are very motivated to make high quality investments because that 20% really depends on what kind of return on investment they get on the startups that they've invested in. VCs know that a lot of the best companies come from places like college campuses where innovation is everywhere and people are very excited to build things, which is why a lot of VCs, like the one that I am a fellow for, have fellowship and internship programs so they can make sure that they have a pulse on what's happening on campuses. And your job as a fellow is typically to connect the firm with the best founders on campus so they can invest in them. There are so many different funds, and you can basically choose to have any sort of investment thesis you want as a VC. So there is everything from women's health, focusing on mental health, gaps in the aging population. And outside of healthcare and bio, there's also funds that only invest in AI, climate, agriculture, blockchain. The list goes on. You can also break down the venture space into a few different categories, and you'll hear these words a lot. The first one is pre-seed and seed. So pre-seed and seed are the first rounds of investment. These are very early in the process for starting a startup and having a successful company. This is usually when you've just started ideating and finding product market fit. You might have some initial customers and initial traction, but you're very early in development. So at this stage, you're really looking for early traction on your idea. Is there product market fit? Are there indicators that this could be a really big, successful company? And what team do you have to make this happen? Each one of these stages is basically a different round of funding. So you're typically raising, depending on how you want to value your company, which is a whole nother conversation, you're raising different amounts for each of these. And so you don't get to Series A until you finish your seed round. It's basically like a chronological process of raising funding, and each one comes with their own milestones and sort of benchmarks to get there. Series A and B is basically early growth and traction. You definitely have customers at this point, and your company has some sort of strong momentum that makes investors excited and interested to continue investing in you and continue putting capital towards your company. So typically, you have hit a point where you are growing rapidly. You're seeing a lot of customer growth or something that shows that you have a lot of strong momentum. There's only a few options as you continue growing your company. Either you're going to flop and your company is going to be valued at zero, or you're going to just ramp down the company, take the L. The other option is you're going to get acquired. So we see this a lot with companies that have really interesting technology, or they might have some component of their company, either the data they've generated, the product they've built, something that another company wants. And so this leads to an acquisition. Sometimes companies acquire other companies because they don't want to have them as competition. Other times they want to outsource. If somebody else is building really cool technology, they want that to be part of their portfolio and their offering. So they might acquire you. Depending on the valuation, your VC might be really happy, or they might be kind of bummed because you didn't get to that $1 billion or unicorn valuation and IPO, which would return the fund much better than you getting acquired for a few $10 million. So from the VC perspective, you really want to look for founders that are going to make it to the IPO, the $1 billion companies, and return the fund. Now that we have the basics, I want to share a few quick tips if you're thinking about VC or if you're thinking about starting a company. First is, if you're interested in the VC space, your experience as an operator matters. For early stage investing, I would say one of the most important traits to have if you're looking to break into VC is to have operator experience. So whether you founded something yourself or you've been a part of something early, an early stage startup, you have built something from the ground up, whether that be a nonprofit or a cool piece of tech, or you've turned something from 0 to 1, and you know how to be an operator, how to get through those grueling early stages of creating something when you don't have a blueprint. Go out, build something, be a part of something early, just kind of understand what it feels like to build something and take it from the ground up. Next tip is for you if you're thinking about starting a company. I'd say the number one tip I have is to make sure you're solving the right problem. So rather than rooting your company or your idea around cool technology, which there's so much of these days, you are going to see so many people in the world that have amazing tech that they can show you. It does this really cool thing. And that's awesome. But does it solve a need? Does it solve a pain point for people? That's what you really need to ask yourself. If it's just cool tech, but it doesn't solve a need, what's going to make people want to actually buy your product? What is it going to do for them? The third and last thing is team. Team. I've mentioned this throughout the video, but I'd say one of the most important things when you're thinking about starting a company is who your team is. Your VC is going to evaluate you on whether you're the right team to solve an issue, to make a company, a $1 billion company, but also it's going to dictate your quality of life. Like, you are going to be spending so much time with this team. Like, the amount of effort and time it takes to turn a company into something great and to scale it into something magical is enormous. Like, everyone always says you're spending more time with your co-founder than your romantic partner, most likely. And it's very true. You have to make sure that you work seamlessly with your team because you are going to be spending so much time with them. Your team is going to be very small. It might just be you and your co-founder, or it could be a small early founding team of a few people, but you need to make sure you work well together because there are so many teams that are solving the right problem. They have the cool tech, but they are not the right team to do it. There are so many teams I've seen at Stanford and beyond that are arguing. They come into issues where now they need to split equity. They have to get lawyers involved. Like, it is a whole thing and it is a big deal. And it's also just very draining. Like, I've been on early teams building in women's health where I had to just like step away because I was so excited about the idea, but like one or two people on the team were just so hard to work with that it was just draining my entire life force. I hope that was helpful and demystified a bit of the VC space for you. If you have any questions or anything else you'd like me to discuss in more detail, please let me know. It's so crazy how your imposter syndrome also goes away with time, and it truly is a muscle. Like, learning to be in these rooms, even if you don't feel ready or qualified, is truly a skill and it gets easier. So keep trying and keep pushing. And if you have any questions, please let me know, and I will see you in another video. Thank you so much for watching and being here. Bye.